If you're over 60 and you haven't looked closely at what's actually changing this year, there are three updates rolling out right now that touch almost every retiree in the country, and most of them arrived without so much as a headline explaining what they really mean for your monthly budget. Not a single one of these came with a letter walking you through the fine print. They showed up as line items buried in agency announcements, the kind of thing that gets a 5-second mention on the news and then disappears. I'm going to walk you through what's actually happening with your Social Security check, what's happening with the number that gets pulled out of it every month before it ever reaches your bank account, and a new tax break that a lot of seniors qualify for and have never even heard exists. My name is Lana Maines, and every week I break down exactly this kind of thing, the financial changes that affect retirees directly, but never get explained in plain language anywhere else. If that's useful to you, stick around, because the way these three pieces interact with each other is not obvious at first glance, and understanding it now can genuinely change what your year looks like financially. Let's start with the piece everyone's already heard a little about, the cost of living adjustment. For 2026, Social Security and SSI payments are increasing by 2.8%. That's higher than last year's 2.5% bump, and for the average retiree, it works out to about $56 more a month, pushing the average monthly check from roughly $2,015 up to around $2,071. That number sounds straightforward enough on paper, and if you stopped reading right there, you'd walk away thinking your check is simply going up by that amount, plain and simple. But here's where it gets more complicated, and where a lot of retirees end up confused every single January when they see their actual deposit and it doesn't match what they expected. That confusion comes from the second piece, which is Medicare Part B. Most people don't realize that if you're enrolled in Medicare, your Part B premium is usually deducted directly from your Social Security payment before it ever reaches you. And this year, that premium is going up too, from $185 a month to $202.90. That's an increase of $17.90 a month, and it comes directly out of the same check that just got that COLA bump. So if you're doing the math in your head, expecting the full $56 increase to show up, what you'll actually see land in your account is closer to $38 more, not $56. It's not that anyone did anything wrong, and it's not a mistake on the bank's end or the government's end. It's simply two separate adjustments happening at the same time, one going up in your favor and one going up against it. And if nobody ever explains that to you, it looks like your raise just quietly vanished. There's a third moving piece tied into all of this that catches higher earners specifically, and it's worth understanding even if you're already retired, because it affects how much money is flowing into the system that eventually pays your benefit. The wage cap, meaning the maximum amount of income subject to Social Security tax, is rising from $176,100 up to $184,500 this year. If you're still working and your income sits above that new threshold, more of your paycheck is now subject to that tax than it was last year. If you're fully retired and living on fixed income, this one won't touch your monthly check directly, but it's part of the same overall picture because it's one of the mechanisms funding the COLA increases you're actually receiving. Now here's where I want you to really pay attention, because this next piece is the one that can genuinely put real money back in your pocket if you know to ask for it. And it's brand new this year. It has nothing to do with Social Security at all. It's a tax change, and it's specifically for people 65 and older. On top of the regular standard deduction, which increased this year to $16,100 for single filers
and $32,200 for married couples filing jointly. There's an additional standard deduction that seniors have always been able to claim on top of that base amount, and this year it's grown to $2,050 per qualifying spouse if you're single, or $1,650 per spouse if you're married and filing jointly. But that's not even the new part.
Layered on top of both of those is a completely separate deduction created just for people 65 and older, worth up to $6,000 per person or $12,000 if you're married and both spouses qualify. Stack all three of these together, the base standard deduction, the existing senior addition, and this brand new bonus deduction, and a single retiree can end up shielding more than $24,000 of income before a single tax bracket even applies, with married couples protecting closer to $48,000. That's not a small adjustment. That's a genuinely significant shift in how much of your retirement income the IRS ever touches in the first place. And I want to walk you through exactly who qualifies for it, because there's an income limit attached that determines whether you get the full amount, a partial amount, or none of it at all. Here's how that new senior deduction actually works in practice, and it hinges entirely on one number: your modified adjusted gross income, or MAGI. If you're single and your MAGI sits at $75,000 or below, you get the full $6,000 deduction, no questions asked. If you're married filing jointly and your combined MAGI is $150,000 or below, you both get the full amount, $12,000 total between you. Above those thresholds, the deduction doesn't just disappear all at once. It phases out gradually, shrinking by 6% for every dollar your income sits above the limit, until it eventually reaches zero for higher earners. So a retired couple pulling in combined income of $90,000 from pensions and investments, well under that $150,000 limit, would qualify for the entire $12,000 without any reduction at all. But a couple sitting closer to $200,000 in combined income would see that deduction shrink significantly, and depending on how far above the threshold they are, it could phase out entirely. This isn't a permanent fixture of the tax code either, and that's worth knowing so you don't assume it'll always be there. It's currently only available for tax years 2025 through 2028. Which means the window to actually benefit from it is limited. And if your income situation changes year to year, whether you qualify for the full amount, a partial amount, or nothing can shift right along with it. What makes this deduction genuinely different from a lot of tax provisions is that you don't need to itemize anything to claim it. You don't need receipts. You don't need to prove medical expenses or charitable giving, and you don't need an accountant to unlock it. It sits on top of whichever standard deduction you're already taking, meaning the vast majority of retirees, the roughly 9 out of 10 taxpayers who already take the standard deduction rather than itemizing, can claim it automatically as long as their income falls under the threshold. The catch is that nobody at the IRS calls you up to let you know you qualify. Nobody flags your return and says, "By the way, you left this on the table." It shows up as a line on the form, and if you or whoever prepares your taxes isn't specifically looking for it, it's entirely possible to file a return this year and simply miss it. The same way people miss unclaimed spousal benefits or unfiled beneficiary forms. Quietly, with no penalty, no notice, just money that never gets deducted because nobody asked the right question at the right moment. So here's what I'd actually do with all of this before tax season gets any closer. First,
Sit down and calculate your household's modified adjusted gross income for this year as accurately as you can using your pension, Social Security, investment income, and any part-time earnings combined. If that number sits under $75,000 for a single filer or $150,000 for a married couple, you're very likely eligible for the full new senior deduction, and you'll want to make sure whoever prepares your return this year specifically applies it, because tax software and preparers don't all default to flagging it automatically the first year a provision like this exists. Second, if your income sits close to either of those thresholds, it's worth looking at whether shifting the timing of any discretionary withdrawals from retirement accounts this year could keep you under the line and preserve the full deduction rather than losing a portion of it to the phase-out. Third, if you're on Medicare and living on a fixed Social Security income, don't budget assuming your full COLA increase is going to land in your account this January. Calculate your actual net increase after the new Part B premium comes out, so you're not caught off guard when the deposit is smaller than the headline percentage suggested.
And fourth, if you're still working and your income is anywhere near that $184,500 wage cap, it's worth understanding that more of your income is now subject to Social Security tax than it was last year, so factor that into any year-end tax planning you're doing rather than assuming last year's withholding numbers still apply. None of these three changes are hidden in the sense of being secret. They were announced publicly. They're sitting on government websites right now if you know exactly what to search for, and none of them require a lawyer or a specialist to take advantage of. But they were never explained to most people in a way that connects all three pieces together: the raise, the deduction that quietly eats into that raise, and the new tax break that can offset a real chunk of what's left. That's exactly why so many retirees end up either pleasantly surprised or quietly frustrated every year around this time, depending entirely on whether someone walked them through the actual math beforehand. You now have that math. Go check your own numbers against these thresholds this week, because the calculation is only useful if you actually run it against your own income instead of assuming it looks the same as everyone else's.